Thank you, Rob. Good afternoon, everyone. As for China, we continue to expect that GDP growth will slow down in the year of 2017 and 2018. However, the path of slowdown would be shallower than we previously thought. So in that sense, we turn a little bit more optimistic than before on the growth. However, we think that the quality of the growth is going to be poor because it's more rely on the old economy and the government investment. We do see that the economy might benefit a little bit from the currency depreciation, as in the real effective terms, RMB now has been much lower than the peak in last year. So it's going to be help on the front of export growth. But we still see that there are lots of headwinds in the economy, particularly from the real estate market. As the government has started to tighten the policies towards the real estate market, we believe the rebound of the real estate investment basically will end very soon and started to decline again, and that's going to put pressures on the growth. So to offset that headwinds and trying to achieve the growth target, which is around 6.5%, we think that the government needs to do a lot to leverage itself to boost infrastructure growth. And that means a fiscal stimulus or quasi-fiscal stimulus for next year. By quasi-fiscal stimulus, we mean it's not the traditional fiscal deficit or government spending deficit. Basically, it's the financing for the infrastructure projects through local governments or the policy banks such as China Development Bank. On the monetary policy front, we expect monetary policy to remain largely neutral, as the room for monetary policy easing is very small because of the surge of Tier 1 cities' home prices and the rising inflationary pressures. However, we think that the room for tightening monetary policy is also very small because the economy is still weak. Aggregate demand is still pretty weak. In that sense, monetary policy will remain largely neutral. We expect one RRR cut, no interest rate cut for next year. And the money market interest rate, the 7-day repo rate, for example, which is now widely seen as the policy rate, will remain largely stable. However, for the currency, we continue to expect that there are pressures for the capital outflow and continuous pressure on the currency to be weaker. On that basis, we see risk bias toward the downside. The first, of course, is Trump administration. Uncertainties around the tension between China and the U.S. might lead to a trade war in a risk scenario. And besides that, other risks are mainly from policy mistakes. For example, although we see rising inflationary pressure, but we don't think inflation will lose control because overall the aggregate demand remains weak. However, the headline inflation indicator could even surpass the government target for the first half of next year, and that's gonna be a very tough choice for the policymaker, whether tightening monetary policy or not. And that kind of create a risk for the policy management and also create a downside risk for economic growth. To sum up, we do see growth might be stable next year. However, the quality of the growth in China will turn poor, and the risk for the long term will be higher.